This week, a lot has happened in the global financial markets, and the global stock markets have dropped significantly within a few days. The question that most people are asking is whether this drop will culminate in a global stock market collapse. The Federal Reserve has been targeting the stock market as a way of boosting economic growth. They have been pumping billions of dollars into the stock market for many years, and now the prices are inflated. The current global panic has triggered stock selling, which is causing the stock prices to tumble on a daily basis. And in the process, billions of dollars in wealth are being lost. In the past week, many global companies are reporting that global supply chains are being affected by this global panic, and earnings are shrinking because of decreased consumer consumption. Asian markets have experienced a lot of equity selling, and the Japanese Nikkei is down over 3%. Similar situations are happening in China. The Chinese stock market is down as investors fear that the situation will get worse in the next few weeks. At the same time, US futures have been rising in value as they are now cheaper to buy. The government has been pumping money to keep everything afloat, even if the real economy and the supply chains have been slowing down. However, no one seems to care that much anyway. Please hold the panic, says the Wall Street Journal. Yesterday, the United States Treasury Secretary brazenly overstepped his boundaries by stating that the central bank will of course cut down the short-term interest rates if the impact of the outbreak grows. On the other hand, much has also been happening in global bond yields. 10-year U.S. Treasuries reached a low of 1.36%, although we are now a little higher at 1.39%, along with equity futures. The market is now expecting the Federal Reserve to cut interest rates later in the year. In the meantime, we just have around $40 billion in new Federal Reserve repo madness to tide up in the next few days. In China, the stock market has also been hit hard by the epidemic. This has caused investors to panic. The Shanghai Composite, SHCOMP, has lost more than 5.6% of its value this week, the worst performance by the index since April 2019. Various benchmark indexes in South Korea and Australia have also lost a significant percentage of their value. The European stock market has also suffered, and the Germany index, DAX, has dropped by nearly 5%. Put into perspective, the global financial markets had their worst week since the global financial crisis. The MSCI index, which tracks the shares of some of the largest companies in the world, has already lost 8.9% of its value. This amounts to the worst percentage drop since October of 2008. Major investors have been spooked by increased warnings from various global companies like Apple, Disney, Microsoft, IAG, and others. The outbreak has reduced the demands of various goods and services, while also disrupting global supply systems. Major firms are reporting reductions in business activities. It is very clear that the panic caused by this outbreak is crushing businesses and financial markets. On Friday, IAG stated that ongoing uncertainty over the outbreak's potential impact and duration mean it's not possible to quantify the total cost. Its shares dropped more than 8% in London. Baidu, BIDU, also said that their revenue could drop as much as 13% in the first quarter of 2020, compared to the same time last year. But what will happen next remains an open question. The situation in China is evolving, Baidu said in a statement. Business visibility is very limited for the near future due to the outbreak. These warnings by various companies are just small reflections of what is happening in some of the world's biggest economies. Growth in China is expected to significantly slow down, as well as in other economies like Japan and South Korea. On top of this outbreak, we have other economic problems, like the US-China trade war. So the outbreak is worsening an already bad situation. According to economists at Oxford University, if this panic continues, about $1 trillion could be wiped out from the world economy. And the global GDP, which has been consistently growing, might experience a 0.1% decline. This might trigger an economic recession in China, the Eurozone, and the United States. Oil prices are also in a bear territory, following a recent 20% decline. This is because oil demand is drying up as more nations transition to clean sources of energy. The global Brent and the Brent crude futures have slid by more than 26% since early January this year, to a price of $50.37, the lowest we've seen in the last 14 months. U.S. oil futures are trading at $45 per barrel, a nearly 29% drop from early January. This correction in the stock markets has caused President Trump to react irrationally, as though the stock market is in big trouble, and a big crash might be coming. The current sell-off and lack of buying, combined with high-frequency trading systems, could cause a major implosion. Since he took office, President Trump has been pumping a lot of money into the stock market, despite the fact that he called it a big, fat, ugly bubble in his presidential debates. Ironically, his administration has been blowing more air into the bubble. Although President Donald Trump is a big proponent of investing in the stock market, he is missing the fact that the markets can't rise continuously. Corrections and crashes always happen, and the price doesn't go up in a straight line. Actually, if this were to happen, the stock market would cease to function. It seems that the president is afraid of a stock market collapse, and the current correction seems to be a major concern to him. Despite him tweeting that the stock market looked good to him, the sell-off has continued, and major U.S. indexes have fallen thousands of points throughout the week. Trump also made another embarrassing attempt to resuscitate the condition of the stock market by tweeting that the U.S. was very close to finding a vaccine for the current outbreak. But a moment later, this was slammed by the White House. The stock market has continued tanking, and the question is, why is the president so concerned with what is happening in the markets? Probably because a stock market collapse will lower his chances for re-election. However, his overreaction is not reasonable, because the stock market will always experience these corrections after a big bull run. The logical explanation of this is that he firmly believes that the stock market is fragile and has a high risk of imploding, especially because of the current panic, reflected in the markets across the world. The modern investment world is dominated by technology, and with high-frequency trading, HFT, the algorithms can easily cause a brutal flash crash, especially at this point, when the market has not experienced a major correction for quite some time. Lately, the buybacks in the U.S. stock market have slowed down, and this makes a repeat of the 1987 stock market crash seem increasingly likely. Not many people are willing to buy stocks now, because the market is oversaturated. Buybacks have been vital to the U.S. economy since the Great Depression, and more recently since the 2008 financial crisis. And corporations have been the biggest buyers of their own stocks. There has also been a sharp increase in retail buyers in the stock market, especially when the markets are at their highs, and every novice investor feels as if they will miss the next big push on the upside. Most retail investors come last, and when the market collapses, they are usually the ones who are left holding their positions. A large volume of buying comes from institutional investors, and the current decrease in buying shows that most of the big investors are bearish and expecting a market correction. The shortage of buyers, combined with high-frequency trading and overstretched valuation systems, are making a crash seem very plausible in the near future. Elsewhere, the Syria-Turkish conflict is escalating every day, with more soldiers dead and hundreds of thousands of people displaced. The US President Trump has just completed a monumental tour of India, where he was met with open arms by the Indian Prime Minister Modi. This has caused a major geopolitical shift as US-India ties grow stronger. The two leaders have also agreed on major trade deals, which have had a major impact on the stock market. The White House has also been insisting that China stick to their trade agreement, as tensions continue escalating between the two countries. Even Bernie Sanders has been talking about US support for Taiwan. The global order is still teetering, and the markets have not yet paid much attention to this. With the current social-economic instability, the markets are quite fragile, and it will not be a surprise if we see a further drop in the stock market.